How important is tax planning in retirement? Well, we feel it's so important that we actually built a tax calculator ourselves. Our firm has built this to show the value of tax planning throughout retirement. So you're going to really enjoy these numbers to see the impact of taking action now while the taxes are low before they go up higher in retirement. So let's talk through this strategy today. So in this calculator we built, we're going to walk through a couple things. The first thing I want to walk through is the assumptions. So again, this is very high level, these calculations, so take this with a grain of salt, but it's going to be a good indicator to show you the value over time. So we're going to go through a case here with a couple who is 64, and they have $500,000 in tax-deferred dollars that we're looking to strategize with. So they did have much more than that, but we were just looking to put together a plan of $500,000 over the next 3 years was a scenario for them. Okay, we're going to expect a 5% growth rate in their investments. They're pretty conservative investors, so we wanted to keep it conservative. And then they're going to be in the 24% tax rate if we are going to do any tax planning today, so we want to make sure we emphasize that. So first we're going to talk through their current plan. So if they make no changes to their plan, what is going to happen? This is what I refer to as Uncle Sam's plan or the IRS's plan. And so I tell people, like, look, if you want to pay more in taxes, don't take any actions and you'll be able to pay more in taxes over your lifetime. And I don't know about you, but most people don't suggest that taxes are going to go down in the future, which means we probably should act now if that's your belief. So let's talk through the current plan here. So in the current plan, you first want to look at the total taxes paid on your RMDs. So what this means is that when this couple turns 73, they're going to have to take out about 4% from their investments each year. The older they get, by the time they're age 90, they're going to have to take out about 9% from their investments. In doing so, they're going to have to pay taxes on all of that money they take out over the years. If we assume that they live till 90, and we assume that, in 2026, since tax rates are going to be 25% for them, and they could be higher, but we're just going to use 25% for illustrative purposes, we're going to expect that they're going to have to pay $201,000 in total taxes during that time period. We also are going to expect that for them, they don't need their RMDs. They already have enough income from Social Security and other aspects of their plan that they don't need this RMD. So when they receive the RMD, they're expecting to reinvest that into capital gains investments. So capital gains investments are taxed at 15% for most people. Unless you've done the right planning, then it could be at 0%. So there's a 0% capital gains bracket that you could be entitled to there. And so in their case, if they're going to take out all of those RMDs and they're going to reinvest it, and then they're going to have to pay tax on all of that growth at 15%, we expect them to have to pay almost $50,000 or just over $50,000 during their lifetime if that's the case. Remember, they don't have to take out those RMDs and reinvest it. If this money was in a Roth, that money can continue to grow tax-free. They don't have to take it out. They don't have to reinvest it. So that's what we're trying to illustrate there for their scenario. The other thing we wanted to point out was Social Security taxes. So you've probably heard me say this before, but Social Security is not taxed to everyone. The people who pay no Social Security tax are lower income people. And I often ask is, hey, does that mean you have to be poor? And the answer is actually yes, but no. You can actually be really smart and show a low income to the IRS by taking money out of tax-free accounts, like you always hear us talk about, Roth accounts, for example. You're able to take out that money. You're able to live on $100,000, but maybe you only show $50,000 to Uncle Sam. So that's the purpose of Social Security taxes. So for them, they're going to force themselves to make Social Security fully taxable by these RMDs on this $500,000 that we're showing here. If that's the case, well, they're going to have to pay almost $80,000 in extra taxes to Social Security that they wouldn't have had to if they didn't have this RMD coming out of this $500,000 throughout their retirement. So that's a significant amount of money that they did not have to pay. And there's also something that is called the Social Security tax torpedo, and that's where they're going to hit that torpedo where you're going to have to pay almost an all-in 40-50% tax if you reach that threshold there. The other thing we have to be aware of is taxes paid by beneficiaries. So for beneficiaries, if you pass away and you leave it to your spouse, then they're going to have to pay taxes, and there's something called the widow's penalty that you need to be aware of. The widow's penalty could cause you to pay double the amount of taxes. So that's one thing you have to be aware of. If you leave this money to the kids, then they're going to have to now take it out in 10 years is what the rules say. And if they have to take it out in 10 years, all of it's going to be taxable during that 10 years. What tax bracket is that going to force them up to? So if we assume a 25% tax rate for the beneficiaries, we're expecting them to pay almost $200,000 in taxes. So this is where it gets fun. Your total taxes paid if you do nothing could be over $500,000 throughout your lifetime. Keep in mind that we only factored in $500,000 for this illustration. So you have $500,000, you could end up paying more in taxes than what you have currently. To me, that's unbelievable. And so I'm going to show you ways hey, how can we reduce this total tax paid over our lifetime to keep more money in our pocket and less to Uncle Sam? And again, I'll make it very clear. If you want to pay more taxes, go for it. But the question I ask is how many people send a donation to the IRS every year beyond what their taxes are due? And typically the answer is no one does that, right? So if that's you, go for it. Pay your taxes. But for me, I want to pay my fair share and nothing more. I want to utilize the tax code to show me more opportunities to save money. And so that's what we're going to do here by just having a simple tax plan. So there's quite a bit of opportunities that we showed this particular client of how they could increase their situation, but we're just going to make it really simple here for you. Let's say that we took this $500,000 and we converted it to a Roth over the next 3 years. Just one of the simple strategies we discussed with them. If we do that, like I said, they're in a 24% tax bracket, so they're going to have to pay $120,000 in taxes right now, today, over the next 3 years. And so I often ask people, are you okay with that? Is that a lot of money? The answer is yes, but would you rather pay this today or this over time? Would you rather pay $120,000 today or $201,000 in the over time? Well, doesn't take a rocket scientist to figure that one out, right? So that's what we're looking at there. The other thing we have to consider is now that it's in the Roth, any growth, as I talked about earlier, is tax-free. We don't have to worry about paying tax on the growth like we do in this scenario here. And so that's one of the advantages of what we're talking about today. Now, understand Medicare premiums are based on your income, so it's means-based. The higher your income is, the more you have to pay for your Medicare premiums. And so what we tell our clients is we always want to try to reduce your income in retirement. One, we can keep Social Security less taxable. Two, we can stay in lower tax brackets. And three, we can keep Medicare from being a higher cost because you're going to get the same benefit as the poor person next to you. So why are we having to pay more when we're going to get the same care? Let's make sure we're paying our fair share, but not more if that's what it's going to be, right? We're getting the same coverage, right? Make it fair. So that's the idea with Medicare premium. So the reason why you're seeing the $15,000 increase here is because Medicare premium is based on your income. And remember, it goes back 2 years. So for them, they're 64. So they don't start Medicare until 65. But understand, when they turn 66, they're going to see this increased amount because of this Roth conversion we did. And so what we did is we did a Roth conversion which forced their income to be higher, which means they're going to have to pay more in Medicare. So you're probably thinking, well, Joe, that's not a good idea. And I'd agree with that. For some people, that's not a good idea. And a lot of times for our clients, we may just go up to that first Medicare premium tier. But when we ran all of their numbers in the rest of our tax planning software, it told us that it would be wise to go above that based on the assumptions that we have and based on what we can expect with tax rates in the future. And so we talked to the client like, hey, here's the situation. Are you okay paying these increased Medicare premiums? He looked at us with a blank stare and he said, what are we waiting on? Taxes are going up. Let's do it now if you guys feel that's the best decision. So for him, we ended up paying additional $15,000, which is a lot of money to do this advanced strategy today. So when they pass away, there's no taxes due on the beneficiaries either. Remember that widow's penalty? We don't have to worry about on this set of numbers, then this $500,000 here. Also, the kids, when they take it out during 10 years, they're not required to pay taxes on it either. Also understand something we understand that if you're going to give a Roth to your kids, for example, make sure you advise them to not touch that until 10 years down the road. Because if you wait till 10 years, they're going to get all that growth tax-free, and then they're going to be forced to take it out that 10th year. But don't have them take it out all in the first year where they lose that tax-free growth opportunity that they're not going to be able to get probably elsewhere. So just make sure you understand that. So if we follow the tax plan that we laid out, he would have to pay a total cost of $135,000 to get all this money to the Roth. which is a lot of money, but remember, we got to pay our fair share of taxes. We're not trying to go to jail and trying to evade taxes, right? We're going to pay our fair share. We're just going to do it in the smartest way possible. So my question to you is, would you rather pay $135,000 through the planning, or would you rather just have Uncle Sam's plan and pay over $500,000? For this scenario, he was able to save over $300,000 in taxes over his lifetime just by simple tax planning strategies implemented correctly and finding those specific sweet spots to do this. And so we often tell people that if you have over $250,000 in tax deferred investments, your 401k, your IRA, money that is yet to be taxed, we feel pretty confident that you could save over $100,000 a year in taxes, not in a year, over your lifetime in taxes, by simple tax planning strategies implemented correctly like I just shared. We actually had a guy come in not too long ago. We were able to show him how to save $2.8 million on taxes during his lifetime. So the more money you have, the more opportunities you have to save. So this is always a fun one. Whenever we do workshops in the community, we always get people that love this calculator, and a lot of our clients love it as well. So if you'd like us to run your personal numbers in this tax calculator to see where you sit, give us a call, reach out to us. There's a link in the bio to schedule a time with us, and one of our advisors would be glad to give you some guidance here to see if we can add any value. So enjoy the rest of your day. Go ahead and subscribe for more videos, and we'll keep them coming.